Trading the bid-ask spread is a specialized approach that focuses on capturing the difference between the price at which a buyer is willing to buy, bid, and a seller is willing to sell, ask. This is most commonly used in high-frequency trading or by market makers, but retail traders can also utilize it through specific execution tactics. 1. Market making. The capture the spread strategy. This is the most direct way to trade the spread. The goal is to act as a liquidity provider by simultaneously placing a limit order to buy at the bid and a limit order to sell at the ask. The execution. You buy at the bid, 10.00, and sell at the ask, 10.05. Your profit is the 5 cents difference. Ideal environment, low volatility, sideways markets with high volume. You want the price to oscillate within a tight range without trending away from your orders. The risk adverse selection. This happens when a major move occurs and you get filled on a buy order just as the price crashes, leaving you holding a losing position. 2. Spread-based scalping. The tick play. Scalpers use the spread as a barometer for momentum. Instead of providing liquidity, they look for spread tightening. The signal. If the spread is usually 5 cents wide and suddenly narrows to 1 cent with high volume on the bid side, it often signals an imminent breakout to the upside. The play. Buy the ask immediately when the spread tightens and the bid size depth significantly outweighs the ask size. Confluence. This is most effective when paired with level 2 order book data to see where the walls of orders are sitting. 3. Spread as a filter for entry/exit. For many active traders, the spread isn't the target, but a risk management tool. The 1% rule. A common rule of thumb is to avoid trading any asset where the spread represents more than 1 to 2% of the total stock price. If the spread is too wide, you start the trade at a significant mathematical deficit that is hard to overcome. Liquidity scans. Look for stocks where the spread is consistently penny wide, e.g., 1 cent difference. This ensures that if you need to exit a trade via a market order in an emergency, the slippage, the cost of hitting the bid, won't ruin your P&L. 4. Technical metrics to monitor. If you are automating or scripting this, look at these 2 variables. Spread ratio, order book imbalance. Compare the total volume of shares sitting at the top 3 bid levels versus the top 3 ask levels. If the bid volume is 3 times higher than the ask volume, the path of least resistance is usually upward. A note on reality. For retail traders, trading only the spread is difficult because of exchange fees and maker-taker rebates. Professional firms often get paid a small rebate for adding liquidity, which pads their spread profits. Without those rebates, your execution needs to be nearly perfect to stay profitable after commissions. Combining bid-ask spread dynamics with price action creates a tape reading strategy. While price action tells you where the market wants to go, the bid-ask spread and order book depth tell you if the market has the fuel to get there. Here is a strategy focusing on spread compression and expansion during key price action events. 1. The narrowing spread breakout. In a standard consolidation, like a bull flag or a tight range, the spread often stays consistent. A high probability entry occurs when the spread tightens or pinches, right as price touches a resistance level. Price action. Price is coiled in a tight range or ascending triangle. The spread signal. The gap between bid and ask shrinks to the minimum, e.g., 1 cent. Simultaneously, you see the bid size increasing, meaning buyers are stepping up and building a floor right under the current price. The entry. Buy as price breaks the resistance level on high relative volume. The tight spread confirms that liquidity is high and there is little friction for a move higher. 2. The spread exhaustion reversal. This is a contrarian play used to spot the end of a trend. When a stock moves too fast, liquidity can't keep up, causing the spread to widen. Price action. A vertical climax run or a parabolic move. The spread signal. As price reaches a peak, the spread suddenly widens significantly, e.g., from 2 cents to 15 cents. This happens because market makers are pulling their orders, fearing a sharp reversal. The entry: look for a shooting star or pin bar candle at this level. When the spread is wide, a small amount of selling pressure can cause a massive drop because there are no bids to support the price. 3. Using the spread as a slippage stop. Price action traders often get stopped out by a quick wick that doesn't hold. You can use the spread to filter these fake outs. The rule: if you are looking to go long at a support level, do not enter if the spread is wider than its 20-period average. Logic: a wide spread at support indicates low conviction. If the spread is wide, a single large sell order can skip through multiple price levels, hitting your stop loss even if the overall price action hasn't fundamentally broken down. Summary table: spread plus price action confluence. Price action context. Spread condition. Interpretation. Action. Consolidation. Tightening. Compressing. Accumulation. High liquidity. Prepare for breakout. Breakout. Wide. Expanding. Low liquidity. High slippage risk. Wait for pullback. At support. Tight. Deep bids. Strong interest. Hard floor. High conviction long. Parabolic move. Rapid widening. Market maker exit. Exhaustion. Look to short, take profit. Execution tip: the limit at mid entry. When combining these, avoid market orders, especially during spread expansion. Instead, use a limit order placed at the mid price. This allows you to enter the trade without paying the premium of the ask, effectively letting the market come to you while the price action confirms your direction. Integrating opening range breakout, ORB, with bid-ask spread dynamics is highly effective because the market is most liquid yet volatile during your 9:45 a.m. to 10:30 a.m. window. Since you look for a 5-minute candle to close outside the 15-minute range, the spread acts as a final confirmation filter to ensure the breakout is backed by institutional volume rather than just a low liquidity spike. 1. The spread squeeze at the 15-min level. Between 9:30 a.m. and 9:45 a.m., spreads can be erratic. As you approach your entry window, watch how the spread behaves at the 15-minute high or low. The setup price approaches the 15-minute breakout line. The confirmation: you want to see the spread compress, get tighter, as price touches the level. If the spread is 5 cents wide and suddenly drops to 1 cent as the 5-minute candle closes above the high, it indicates that market makers are providing heavy liquidity to facilitate the move. The red flag: if price breaks the 15-minute high but the spread widens, it suggests thin liquidity. This is often a fake out, where a small number of orders push price up, but there isn't enough depth to sustain the trend. 2. VWAP slope plus spread confluence. You already used the VWAP slope for institutional momentum. The spread tells you the quality of that momentum. Long bias: VWAP slope is positive, plus price is above VWAP, plus ask size is being eaten rapidly. The strategy: when the 5-minute candle closes outside the ORB range, check the level 2. If the ask side has large walls, high volume, but the price is still moving up and the spread is staying tight, it means institutions are aggressively buying into that supply. This is a high conviction ORB entry. 3. Using spread to manage your $320 risk. Since you use a fixed risk model, slippage is your biggest enemy. A wide spread can turn a $320 planned risk into a $450 actual loss if you get a poor fill. ORB scenario: spread condition. Action: clean breakout, penny wide, 1 cent to 2 cents. Market or limit at ask. High confidence in 1.25%. Risk parameters: volatile breakout, wide/gapping, 10 cents plus. Limit order only. Avoid market orders to prevent blowing past your $320 risk cap. The flush: spread suddenly doubles. Wait. Rapid spread expansion during an ORB often leads to a V-bottom or V-top reversal. 4. Practical scripting tip: If you are building this into your watch list signal columns, you can create a liquidity score formula. If the current spread is 2 times the 30-day average spread during the 9:45 a.m. window, have the column turn yellow or red to warn you that an ORB entry might result in high slippage. By the time you hit your 10:30 a.m. cutoff, spreads usually stabilize significantly. If you see the spread widening as you approach 10:30 a.m., it's a strong signal that the opening juice is gone and it's time to stop hunting new setups.